Hello, everyone. I'm your host, Cam Webster, and welcome to The Art of Boring, the podcast where we dive deeper into Moore's investment philosophy and thinking in order to help you, our listeners, become more informed investors. Ultimately, we hope to connect you with the people at Moore who find excitement in delivering on Be Boring, Make Money.
This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Any views expressed in this podcast are based upon the information available at the time and are subject to change.
Today with us is Greg Peterson. He's head of some of our balance strategies and chair of our asset mix committee. So every quarter we've been having Greg on to just give us an overview of what markets have done, maybe a little bit about what we've done about it, and just a little look forward. So that's the setup, Greg. Welcome back.
Hi, Cam. Good to be back. Nice to have 2018 behind us.
Yeah, well, let's start on that note. Nice to have it behind us. So, I mean, we're joking there, but what was behind that comment? Like, why are we glad to see 2018 behind us as investors?
I was kidding a little bit. Yeah, so 2018 naturally ended with a much more volatile environment than what we've been used to for some time. Markets have behaved for many years. Really, since 2009, we haven't had very many disruptions in equity markets globally. There's been a few hiccups here and there. And so I think this is the first time we've experienced declines as quickly as we have for a while. So this might be relatively new to some investors, and it could be just a bad memory for others that has been carried forward. So it was a more difficult time at the end of the quarter. We've talked about volatility increasing for some time. A few people have commented to me, well, you're just telling me that it's not really going to happen anymore. But no, we are seeing that now. And so that was expected, and now it's come to fruition as well.
Give us some perspective on what were some of the catalysts in the quarter in particular. So fourth quarter was a big kind of negative quarter for equities and a not so negative quarter depending on where you were positioned in bonds. So what were the catalysts out there?
Yeah, I think there's a few things that have led to this. So one is you've had really good markets for some time. So stock valuations may have been a little bit on the expensive side, or certainly higher anyway. So that already leads them to be a bit more subjective to change or to disruptions such as we've seen in the last few months. The real catalysts were likely expectations around, or concerns rather, around growth going forward. So where's economic growth coming from? It is slowing, so the growth cycle is likely peaked. And so there's some concerns about where do we go from here? How quickly do global economies slow down? The other sort of combined with that was rising interest rates. So the US has been raising rates for some time. Canada's raised rates 5 times in the last year and a half. And so higher interest rates are not necessarily good for equity markets either. So those are probably two of the main concerns. And then, of course, the other, just to top things off, is concerns around global trade, tariff wars, and particularly the dispute between China and the US and what that means for global trade and how that relates to economic growth as well.
Okay. Capital markets are voting machines. We've heard that out there quite a bit. So the past quarter, the votes were that, broadly speaking, equities are overvalued because there's the bond market saying something else about future economic growth and the speed with which interest rates were being raised. So leading into something called the flat yield curve and whether that was, let's talk about that for a brief moment and give listeners some perspective on whether that's a signal or not that times are changing.
Yeah, flattening yield curve. So flattening yield curve typically does lead to slower growth. So if you think of from a bank's perspective in credit creation, banks tend to borrow short and lend long. And if you have a flat yield curve, that means that short rates are about the same as long rates. And so there's really no incentive for the financial community to be lending money because they don't earn the same spread on that. So they don't have a financial incentive to go that. It does oversimplify things a little bit, but that's sort of the premise of that. From an investor's perspective, if you're not being paid to take risk by going longer on a yield curve or for other long-term assets such as stocks, then you're probably better incented just to park money in short-term because short-term rates are higher, at least relative to the longer-term rates. So there's a natural effect from flattening yield curve. I think from a psychological perspective too, a flattening yield curve could lead to an inverted yield curve. Inverted yield curve is where short rates are higher than long rates. And historically, an inverted yield curve has led most times to a recession. So it's been a bit of a forecaster, if you will, of pending recessions. I'm not sure that it works the same way this time around. So we have had a great deal of central bank intervention in markets for the last 10 years, and they have perhaps disrupted that message that the yield curve is sending us by manipulating that yield curve through quantitative easing or just through manipulation of interest rates. And so I'm not entirely convinced that the message is as sound as it's been in the past. And so we may have a flatter yield curve. It may or may not lead to a recession at some point. Although, as the world tends to go through cycles, a recession comes at some point. So we just don't know whether that's a year from now or 3 years from now.
Okay, so we get into a little bit of looking forward there for a minute. We'll, I think, round back to that. Let's just talk a little bit from an asset class point of view, how returns shook out in the quarter. And maybe dive a little bit more into bonds and building a balanced portfolio. So give us some perspective on if you were a balanced investor in the fourth quarter, how did that actually shake out?
Yeah, so for a balanced and well-diversified investor, just for instance, our balanced fund was down 3.6% in the quarter. And so depending on how you look at that, that may have been good or not so good. Definitely from an absolute perspective, we're never really happy having a decline in asset values. Relative to the decline in stock markets, it's been much more attractive that way. So the diversified investor has benefited from that diversification. As the expectations were changing in the equity markets, perhaps towards slower growth, same thing was happening in bond markets. So we saw bond yields ease. So bond yields have moved lower, and that's caused bond prices to move up, which is exactly what we'd like to see in the environment where equities are dropping. We'd like to see bonds moving higher and providing a bit of offset and helping to reduce that volatility for balanced investors. So that worked in the past quarter and through the course of last year as well. And then the other thing that's worked for us, in addition to bonds and cash preserving value in the fourth quarter, was the Canadian dollar. So the Canadian dollar tends to be a fairly volatile currency globally. We're not one of the reserve currencies of the world, which would typically be the US dollar, Japanese yen, Swiss franc, sort of top three, or three that come to mind anyway. And so because of that, when we have this sort of fear in the market or markets selling off, the Canadian dollar tends to do that as well. And given that we have a fairly high concentration of assets outside of Canada, that drop in the Canadian dollar increases the value of those assets for a Canadian investor and helps to offset some of the decline in equity markets globally. So a few things worked in the quarter. Bond improved in value, cash naturally held its value, and then the drop in the Canadian dollar was good for Canadian investors as well. Maybe not so good for their holiday plans if they're going outside of Canada.
True, yeah.
But it certainly worked better for portfolios.
So just on the Canadian dollar, let's dive into a little bit of the reasoning behind the weakness in the dollar. Is it Bank of Canada certainly said a few things on the quarter. Oil prices have something to do with it. So let's just get your perspective on where the Canadian dollar's at and why.
Yeah, there's many things that contribute to currencies fluctuations. A few of the main items are expectations for economic growth in that country. And so I think the Canadian dollar has declined partly because of concerns over economic performance in Canada. So Canadian growth has been slowing, much like other developed countries. So that's not something that's unique and would necessarily cause the dollar to drop on its own. I think some of this fear from a psychological perspective also contributes to that. So as I was saying, when markets are selling off, the Canadian dollar tends to decline in value as well. So that may have contributed a little bit. But more to what you were mentioning with the Bank of Canada. So the Bank of Canada has been pretty set on raising interest rates, as I mentioned, having done that 5 times since mid-2017. I think expectations are that the Bank of Canada is not raising rates as quickly going forward. And because there's a shift in that expectation that interest rates in Canada don't rise or rise much from here, then the appeal of Canadian bonds and the dollar isn't the same as it would be otherwise. And this is usually looked at in relation to other central banks. So the easy example is Canada and the US. That's what most of us tend to see and follow all the time. And so as expectations were that the Bank of Canada is not raising rates as quickly, the Federal Reserve has still been raising interest rates, is still expected to continue raising interest rates, and that's helps sort of to bid the US dollar versus the Canadian dollar, if you will, and causes our dollar to decline in value relative to the US.
Just to cue in on central banks for a minute, I'm curious what your perspective on, we've had rate rises. How much dry powder would a central bank have now on a go-forward basis? Like, what's your opinion there?
Yeah, there's lots of debate about the level of where central banks have gotten to with interest rates and whether they've gone too far or not. Regardless of that, they have sort of reestablished interest rates and they're no longer at zero. They're significantly above that. So they've given themselves enough dry powder, if you will, to work with so that if things did slow significantly, the Federal Reserve in the US or the Bank of Canada can start to reduce interest rates from where they are now. And so whether they have very far to move or not, it's just that signal that message is generally received by markets, and whether it's just affecting stock markets or perhaps it's helping companies that are making investment decisions have a bit more confidence that perhaps interest rates are not moving significantly higher, and they may be more inclined to start to invest a bit more now as well. So the message is not just to markets, but tends to be to businesses and have a real effect as well. And I think they have enough room now to be able to do that if they need to.
Okay. To me, that's a positive potential that maybe the market's missing. Let's talk a little bit, shift gears a little bit just to asset mix specifically. So as a balance manager, how did you start the year in terms of view and asset mix? How did you end the year, and maybe a little bit about where we're going?
Yeah, the start of the year was significantly different than the end of the year.
Sure was.
So at the beginning of the year, we still had asset equity markets doing quite well. And so our position, whether it's beginning of this year or the middle point of this year for that matter, and the year or so prior to that, was really trying to keep equity from drifting much higher in a balanced portfolio. So what I mean by that is as equity markets are doing very well, they're performing stronger than bonds and cash, they tend to become a higher percentage within your portfolio as a balanced portfolio. And so we've been trimming equities regularly just to keep them from moving too much higher. So we already had some, not necessarily concerns, but we knew we were sort of later in the cycle. Valuations weren't as appealing. Earnings growth was starting to peak perhaps at the beginning of the year. And so we didn't want equity to get away from us. And so part of that risk management is just to keep that in check by trimming from time to time and reallocating. It's interesting, as we went through 2018 earlier this year, we were often asked, well, why are you trimming equities in favor of bonds? Bond yields were very low.
Yeah, like why own bonds?
We got that question frequently. Yeah, why own bonds? Well, we now remember why we own bonds in the portfolio.
A little bit of a punch to the gut of a reminder there, but yes.
But those reminders are helpful from time to time. So
Absolutely.
As much as we don't like it and things are uncomfortable for a period of time, I think they do help investors to come back to some reality and remember why they're there. And bonds are there, quite frankly, to provide that stability within the portfolio and to provide some level of income as well. So we were adding to bonds at a time where bond yields were becoming more appealing at one point. So the 10-year Government of Canada bond peaked out at just over 2.5%, roughly. Relative to where we've been the last several years, that was fairly high. Turns out in hindsight, that was a good value, at least short term. And bond yields more recently had bottomed out around 1.8%. We're back up to just over 1.9 as we talk today. But so that's why we were reinvesting in bonds at the time, selling assets that are relatively expensive and buying assets that are relatively inexpensive.
Okay. And where did asset mix end the year at? And let's talk a little bit about, are you planning to change it based on conditions and risk out there? And maybe you can give us a quick, what are your top 3 or 5 risks looking forward, and what does that mean for asset mix?
Sure. So we ended the year just below neutral for equity. So equity in the balance fund is 60% would be our neutral position. We were just below that at the end of the year from trimming. Then the market did help to take that a little bit lower at the end of the year as well. And then we were slightly higher naturally in bonds. And then cash was a bit overweight in the portfolio too, wanting to be somewhat defensive there. So that's where we ended the year. Slightly different from where we started the year. When we started the year, we were slightly overweight equity, underweight bonds. And so that position reversed to some extent. Within the equity mix, things haven't changed that much. Relative weights perhaps are a little bit. We continue to be slightly underweight Canada. So we still have some concerns about headwinds here, despite the fact that valuations in Canada are probably more appealing than they've been for some time. We continue to be slightly overweight within the US. And for a couple of reasons, valuations are not as compelling, naturally. So the US market is still relatively expensive, but the US economy is also on better footing. Companies are performing relatively well, despite sort of the trade talk and disruptions that are taking place. And then we have the benefit of the reserve currency as well. So we don't lose sight of the fact that we're investing in foreign currencies as we're adding to stocks globally. And so if things do turn, as they did in the fourth quarter, the US dollar tends to hold value quite well. So we still have a higher position there. And then we still like the diversity of international markets. There are many different types of very good companies, despite some of the geopolitical concerns that are out there at the moment. They're good companies with good management teams that know how to work through that and manage through whatever situation may be coming up. So we continue with that diversity in the portfolio. In terms of where we're making changes, most recently we have just repositioned to add a little bit back to equity. And it's not that we've been buying and find that things are terribly compelling. We just didn't want equity to drift significantly lower in the portfolio. Did feel that the sell-off at the end of the year was fairly sharp. may have been slightly overdone given conditions. So even though economic growth is slowing, it's still positive. Earnings growth has slowed, earnings are still positive. And despite interest rates having increased, they're still relatively low. So the environment for equities is not that bad. And so the sell-off in the short term may be a little bit overdone. Time will tell. Perhaps as we're talking next quarter, we'll find out where that's
Good,
at.
you're coming back next quarter. All right.
Yeah, but that's all very short-term thinking. So what we're really trying to do is position the portfolio appropriately for the next 2 to 5 years or longer, and not try to react or position for the short term.
Yeah, well, I think in this podcast, we've actually managed to cover the drift subject. So we've gone above 60 and we trimmed and the market takes us below. So now we're trying to get back to that. It seems that as a balance manager that it's tough to predict markets, admittedly, but if you have that 60% marker in front of you, it's a good ballast that is a reminder that, well, actually, maybe we're overdone. Maybe valuations are high. Is that something you look at on a regular basis?
Yeah, we look at it very regular and daily, in fact. And so, yeah, we haven't moved quite back to 60, but we've just kept a floor under equities for the time being.
And then on asset mix, maybe we can close out the conversation here, Greg, is our firm is fundamentally driven by our research team and the portfolios we build stock by stock. Was there anything in the quarter, in the fourth quarter, that stood out that the portfolio teams have done to position portfolios in the current environment?
Yeah, the portfolio teams have been working for the last few years knowing that, perhaps valuations are a little bit high or eventually you come to an end of a cycle and so forth. And so they've been working to make sure that the portfolios are quite resilient. It's a word you hear often from us. And that's really making sure that valuations within the companies that we own haven't become too stretched. And so typically in the last few years has been trimming or selling those businesses where we think they've become too expensive, either given the current environment or the pathway for growth for that business and what have you. And so the team has done a good job, I think, of managing that and trying to move capital to businesses that they feel are better positioned to withstand perhaps a recession or at least some downturn and take away a little bit of that volatility. So, despite the fact that the fourth quarter was negative, we were pleased to see most of the asset classes on the equity side outperform their benchmarks. And so I think that's because of that resiliency. It also, from a balance perspective, then helps us to provide value for the balance fund if each of the underlying asset classes are also performing better than their benchmarks. So I think some of that resiliency has definitely paid off. You never really know about that until you go through a downturn. And so we've been pleased to see that hold up the way we expect it would.
So, Greg, you're mentioning resiliency and how each asset class is trying to build that. Some worries about valuation, so we're trimming some highly valued names and adding something that's maybe not as recognized in the marketplace. So can you give us an example or two of a company that's been added to the portfolio that fits that criteria?
Yeah, there's quite a few. So companies that have been added with the expectation that they provide that resiliency and defensiveness in the portfolios, if you will. So one that was added over a year ago is SocieteBIC in France. So the maker of BIC razors, BIC lighters, pens, and so forth. So it's a fairly common name. Yep. Not a very exciting company. It wasn't added with expectations for tremendous growth rates. It was added because it has a fairly consistent and reliable revenue stream, and that generally translates into something that's also fairly resilient in down markets. And combined with that, the stock price, it's not a very flashy company. So while tech stocks perhaps are getting a lot of capital moving towards them and pushing prices higher, BIC was at a more reasonable valuation. I
think the flashiest part of BIC I've seen is if you go into Staples and you buy the 5-color pen. Anybody remember those 5-color pens? I'm dating myself. I actually bought one recently, but anyway.
So it appears that there are lots of people still buying BIC. And just to give an idea of how that worked in the quarter, so BIC was up 13% in Q4. Weren't really expecting it to move higher, but that helped from the defensiveness as well. And if you continue with flashy in the United States, we added Ecolab. So Ecolab's a maker of cleaning materials and consumables for industrial application. Again, very steady, reliable business. Cleaning materials, not particularly flashy either. So you have a pretty good, reliable company at a relatively reasonable valuation to the market. So.
Okay, and in a recurring business kind of revenue model.
Yeah, absolutely.
Yeah. Okay. Thanks for those examples. There makes it clear in terms of how we're building resiliency. We can close on this question. What are you losing sleep over these days in markets?
There's always lots to lose sleep over. What we're really good at doing is losing sleep and being concerned about the risks and not always focusing on opportunities. So there's lots to be concerned about there. I think there's a few things. The leadership in the United States causes lots of concerns. And as much as there's plenty of noise in the media, I think you still worry a little bit that may turn into real concerns. It's in nobody's best interest, whether it's the United States or China, to have this trade battle carry on for much longer. But that's a concern that actually translates into something real. Something real means tariffs that are on or in place for a very long time. That's a big cost to consumers and business, and does tend to drag down trade. So that would be one way that the cycle ends. I think the other thing that I think about a bit is just central bank mistakes. So I don't think that that's as likely, but central banks can move too quickly and too far and raise interest rates too much and cause some problems that way. So that's another that you tend to be concerned about, although signals in the last while have been, especially from the Federal Reserve, that they're well aware of changing conditions and they'll watch that, and they're not necessarily on autopilot going forward. And so expectations for higher interest rates in the U.S. have eased in the last while, as they have in, I think, a lot of developed countries. But
all right. So lots to worry about.
Always lots to worry about.
So much responsibility as a balance manager. So thanks for being here to give us some perspective on the fourth quarter. And as you mentioned, you'll be here next quarter. So thanks again, Greg.
Thanks, Cam.
Hey everyone, Cam here again. To subscribe to the Art of Boring podcast, go to more, that's mawer.com/podcast. If you enjoyed this episode, leave a review on iTunes, which will help more people discover the Be Boring, Make Money philosophy. Again, thanks for listening.